So let's bring on board Sunil Bohra, the CFO at Minda Industries, and chat about where he thinks the business is going to be headed. Sunil, hi, morning. Congratulations. You've seen your highest ever quarterly performance so far. But what happens from here, Sunil? If you could just tell me about where is it that you actually see growth for your PV and CV segment going forward, given all the dynamics which are currently at play for the industry?
Right. So we all know that both the PV and CV segments are doing pretty well. Unfortunately, PV segment, we still having the supply side challenges. The demand remains very, very robust. So we are very, very bullish on PV segments. We all know that there are long bookings for various models. So from PV segment perspective, we are quite confident that the semiconductor shortages are easing gradually, and we are seeing that in the production numbers also. And also in terms of CV segment, I think that segment after the change in the Excel load norms in 2018, I think after a long hiatus, we are seeing a good demand pickup. And from that segment perspective, if you remember, we have acquired a company called Harita Seating last year. And with that, we have got a good entry into some of the CV players where we are not there. So our strategy is how do we gradually sort of put in more products into those customers. We are sort of approaching them, getting the RFQs. There is a good traction. So we are seeing the CV side also, the business doing pretty well. And we are also gradually increasing our share of business in various products. Now, if I talk of PV segment, be it lights, be it switching, be it alloy wheels, I think across the board, we are seeing multiple advantages, I would say. First being the premiumization-led growth, then also our share of business, we have been sort of gradually improving. So all in all, from PV and CV segment, I think both the segments are doing pretty well, and we are pretty confident that we should be able to increase our share of business as we have been doing in past.
Sure. Sunil, it all looks well. The only one problem is your guidance and margins, which you think is going to continue to be in the 11 to 12% range for FY23. Is there really no room for upside on margins going beyond this range of 11 to 12%?
Yeah, so if you see, we have actually last year being in the range of around 13%, 13.5. But this commodity price run up, what happens is that even if you are able to pass on to your customers the commodity prices, it increases your base effect. So even at the same absolute margin, the percentage actually looks lower. So had the commodity prices not have increased the way they are, actually we have been today at around 13.5% margin. That's number one. Number two, from 1st of April of 22, we have got started a merger of Harita Seating, and we knew that that is a margin dilutive business, but it is a high asset turn. So in terms of overall return on capital employed, it sort of comes equally with other businesses. So the guidance of 11 to 12% range, I would say is a very good. If you compare to the industry peers, I think we will be in the top quartile.
In general, the feeler is that auto is going through a tough time, and you're an auto ancillary company, which means if OEM slow down, you will also face the heat.
Right.
But that I'm looking at your capex. The capex for FY22 stood at 5.8 billion, and the management has guided for 5.5 to 6 billion for FY23, and it could go higher than that. Why is that? I mean, isn't this time to slow down capex when sector is slowing down?
So Nikunj, I think it's a very, very good question. But what we have been doing is, if you remember, even a couple of years back, when the entire world was sort of slowing down on capex and opex, while we did put significant brakes on opex, we didn't stop our capex because we still believes in the potential of the economy and medium to long-term growth. We don't want that this knee-jerk reaction to impact the company's long-term growth territory. Now, having said it, our goal, as you know, has been consistently to outperform the industry growth. Now, if you have to outperform the industry growth, you have to consistently reinvest in the business and definitely reinvest where there is a profitable growth. So if you see, even in the last quarter or the last year, while the industry in the last quarter has been negative around 17%, we have grown by 9%. Even if you are in order to exclude the commodity price impact, there is a good 15% kind of outperformance related to industry. So if you have to continue outperforming the industry, you have to keep on reinvesting the business. And as you would have seen, currently we are already in process of expanding our alloy wheel plant. We are currently in process of putting a 4-wheel lighting plant. board has recently in this meeting approved setting up of the lighting facilities in Vietnam. We are expanding our four-wheeler switches in Chennai. So we have been consistently sort of trying to reinvest in the business and see that this growth which we are able to capture, and we can timely capitalize on it. If you don't reinvest, there might be a scenario where you might lose out on any opportunities. So it's like a egg and a chicken story. What comes first? You want to business first, you want to invest first. So we try and sort of minimize our risk. We don't want to upfront the investment, but at the same time, we are also trying to capitalize on the opportunities, and that is what is helping us to increase our share of business and also get this kind of growth which we have been delivering.
Let's look at two scenarios. Commodity prices stay where they are for rest of the year. What happens to your margins? And if commodity prices, they come down by 10% from where they are, what will happen to margins?
Yeah. So, Nikunj, it's a very good question. And in fact, if you recollect last year also when we spoke, when the prices go up, there is always a lag impact where you pass on this price impact to your customers. Same way when prices go down, you have to pass it back to your customers. So we don't keep in our pocket. Yes, there might be timing difference of a quarter or 6 months here and there, but over a year period, then everything is passed through. So if prices also goes down, it might not have any significant benefit to the profitability. And also if prices remain same, our guidance is assuming the prices remain same where they are in terms of 11 to 12%. Yes, if there is little bit of softening, we might be maybe at around 11.5 to 12 rather than 11 to 12.
Good morning, Sunil. But taking forward that point, because in the conference call, you've also talked about premiumization. You've talked about, from moving from analog kits to digital kits, etc. Shouldn't that then help margins?
So there are 2-3 things on this point. First, definitely is in a medium term, you are 100% right that the premiumization should lead to better margins because maybe the alloy wheel as a business has got a low asset turn. So you to justify the same return on capital employed, you will need a little bit of better margin. Now, coming to your digital keys and all that, what it does is it increases your kit value. So on increased kit value, you have to maintain the same percent of margin. Absolute profit actually improves. So even in terms of premiumization, what it does, it increases your value, it increases your kit value, and in essence, even if you are able to maintain the same percentages, your absolute profitability improves.
Okay, so that's Minda Industries for you, higher by 5%. It's also looking for higher business from the EV space as well, maybe 20 crores to 80 crore rupees in the next 2 years. There's also, of course, been a bonus issue, 1:1 bonus issue. Thank you so much for joining us live today on this edition of The Market.